Russia continues to ramp its war expenditures against Ukraine. According to the state budget, defense spending in 2025 is projected to reach 13.2 trillion rubles, equivalent to approximately 38 billion per day. This relentless financial drain comes at the expense of social programs and is also causing a significant labor shortage. A survey by the central bank reveals that 73% of Russian enterprises report difficulties finding workers. Additionally, massive investments in the defense sector are overheating the economy, fueling inflation. The central bank has attempted to combat this by repeatedly raising the key interest rate, effectively making borrowing more expensive.
From the central bank's perspective, the solution is straightforward. It aims for a balanced economic growth rate of 1.5 to 2% where supply matches demand. Current growth rates, which have exceeded this ideal level for 2 years, result in demand outpacing supply, driving inflation. The goal is clear: reduce excess demand and bring growth back to 1.5%. This can only be achieved by increasing the interest rate, from the Forbes publication.
However, experts warn that this approach will not resolve the underlying issues. On October 30, 2024, the central bank raised the key interest rate to 21%, the highest since 2003, when Russia was grappling with the aftermath of its 1990s economic crisis. Speaking before the State Duma, Governor of the Central Bank Elvira Nabiullina called for even stricter monetary policies. Russian economists argue that such measures are not only ineffective, but could also exacerbate the current crisis.
The current high key interest rate, coupled with the central bank's plans for further increases, creates a significant risk of economic recession and a collapse in investments in the near future. This policy offers limited effectiveness in reducing inflation, but carries unacceptable risks of provoking a downturn and destabilizing production in the real sector. From the review of the Center for Macroeconomic Analysis and Short-Term Forecasting.
Experts note a growing rift between the government and businesses over Russia's economic future. In a recent report, a Russian Union of Industrialists and Entrepreneurs proposed introducing a separate, regulated exchange rate for businesses and called for amendments to the Central Bank Act to make it more dependent on the Cabinet of Ministers.
The RSPP is proposing a completely different system. Currently, only central bank leadership sits on its board of directors. They want to integrate government representatives, effectively giving them veto power over monetary decisions. But the core issue isn't the mechanisms. They're essentially arguing for central bank decisions to be driven solely by the criterion of economic growth. Inflation, they suggest, can be tolerated since it's already high. What they want is access to cheap money to freeze its growth.
Analysts at the Institute for the Study of War predict that Russia will face severe economic challenges in 2025. They argue that the central bank's reactive measures, combined with demographic problems and labor shortages, reveal that Russia is far less resilient to Western sanctions than the Kremlin claims. These economic strains may undermine Russia's ability to sustain prolonged military operations. Reported by Bastun Katerina, Andriy Dmitrenko, UATV News.